All right, what's going on, everybody? Thanks for joining me on this Saturday morning. What a week it's been. We got a lot to talk about today. Give me a little shout out in the chat as usual, who you are, where you're from. If you're drinking some coffee or something this morning, let me know what it is. Mine is a caribou. And if you've got a good name for what's gone on this week, I came up with from the negative side, Tariff-Geddon. And if you're positive about tariffs, which maybe a few of you are, we'll call it Tariff Palooza. That sounds a little better. But let's see who's in here. We've got Tim. What's going on? Tim's a regular from Chicago. Laura, what's going on? We got Jason from DC. Ted, what's going on? We've got Dominic. What's up? Will, another regular from Jacksonville, drinking the Kona coffee. Anu, what's going on? Another regular. Dom's from Colorado. We've got Caesar, a lot of regulars in here, and I've seen a number of new people as well. Donald, what's going on from Connecticut? Carolyn, how's it going from Dallas? Drinking Diet Coke. I can't drink soda in the morning. I have a lot of friends who do that, but I've tried. I can't. Alex, what's going on from I'm assuming that's LA and not Louisiana. So you're not too far from me. I'm out here in San Diego. And if you guys haven't noticed, I'm coming off a kind of a flu cold, so I might sound a little raspy or hack a little bit. I'm getting a lot better though. Indo, what's going on? We've got Jordan from Colorado as well, drinking a dark roast. Timothy, Chicago suburbs. Victor from Seattle. Neil from Scotland, our first international member here, drinking coffee even though it's dinner time. I do that as well. Coffee doesn't keep me up that much. I can drink coffee at night. Daniel, what's going on from WMT? I don't know what that is. AKA Northwest Arkansas. Okay, there we go. We've got Viraj. What's going on from Alabama? I don't think there's too many Virages in Alabama. That would be my guess. We've got Tracy from Oklahoma. Steve from KC with coffee. Richard's drinking the 100% Arabic Colombian. Joy, what's going on from LA? Kathy from Santa Barbara. That's my daughter's favorite city. We've got PJ from Carolina's coffee. Theru from Michigan. We've got a big turnout today. I don't know if I can call out everyone. I hope I'm saying your name right. Zeriona. Is that right? From New Orleans. We've got Jamie from Hawaii. That must be pretty early there. Georgie, Moldova. Richard, what's going on from Chicago? My buddy Dennis here from San Diego. Dennis, we got to get together. It's been too long. Hawa from a butterfly from our chat, drinking hibiscus tea. Mahul from Maryland. I don't know if I can call it out. We've got too big a list this morning. Dorothy Ann from Long Island. I don't see any good names for this week, so I think we're going to go with Tariff-Geddon. I was hoping one of you guys would have a good name, better than Tariff-Geddon. I know that's pretty generic. We got Richard from New Jersey drinking tea. It's either Jan or Jan from the Czech Republic. Must be pretty late there. And then Marty from Michigan. All right, good turnout this morning. We got a lot to talk about today. We're gonna go over all this tariff stuff really quickly, especially a lot of you who follow me or are members already. We've talked about a lot of this stuff to death, but still worth going over, and especially for you guys who aren't members. Some overall strategy talk in terms of how to handle volatile markets. You don't want to be trading the same as you normally do. You need to make some adjustments. And what you see happen a lot of times with traders is trading very well, whether it's a down market or an up market, but a nice trending market. And then all of a sudden something like this happens, and in a span of like a week or two, you give up a lot of your gain. And that's not what you don't want to do. Now, during these periods, you are probably going to take some losses, and that's fine. But it's managing those losses. So we're going to talk a little bit about how you handle these volatile periods. And then we're going to preview a little bit. Starting on Tuesday, there's a new swing course. And I'm going to go over swing setup that we've gone over a lot in here. So it's just a quick And then we're going to talk about an option strategy that works very well with that. Those of you who don't trade options, that's fine. And especially if you're taking that class and you're worried, oh, is this going to be an options class and I don't want to do options? The option stuff's going to be in a bonus class. So don't worry about that. A few stocks to watch right now, and then game planning what's going on here and how do we look at this going forward. And those of you who don't know already, there's a swing class starting on Tuesday. The link is right here. I'm going to put it in the chat if you want that. And then I think you guys, let's do host and palace. Okay, here's to everyone. And I didn't know this, but I guess you can't cut and paste from the chat, which seems really odd that they don't let you do that. But anyway, yeah, it starts on the 8th, I think it's the 8th, 10th, and 12th are the classes, and then we're going to do a bonus class as well, and I haven't scheduled that yet. Okay, and then of course for the swing service, there's a 14-day free trial. You can join that here at Bulls on Wall Street Swing Trading, and you guys know whether you're a paid member, whether you come to these stocks and coffees, whether you email me, you're part of the Bulls family, you can contact me anytime at all. singjd1@aol.com and I'll get back to you. If you want my TC2000 layouts, if you're on that, contact me as well, or just any questions related to trading. I love chatting about it, so go ahead and email me. Of course, Bulls on Wall Street, my own site, Paul J. Singh, Twitter, Paul J. Singh, and then Instagram, The Real Paul J. Singh. Okay, I already see some questions in here. Okay, I haven't even looked at any of the news this morning. Richard is saying a 5 trillion tax cut was passed this morning. I just literally just woke up, got ready, and jumped on here. So I haven't seen any of the Saturday news. I usually shut off. Nothing's going to happen until Monday, so I usually shut it off. I want to relax on Saturdays, and then starting Sunday evening, I start to review if there's anything I need to know. But obviously, if that's true, okay. Everyone's saying Senate passed it. So what I would do now, unrelated to what we're talking about here, but watch how Sunday futures react. So Sunday evenings futures opens up. And that gives you a general idea. Now, a lot of times stuff changes by the Monday open, but that'll give you a good idea of what the market thinks of this. Okay, all right. So let's talk about it. Let's get to it. Tariff-Geddon, Tariff-Palooza, however you want to look at it. And not one person here gave me a good name, a better name than these generic names here. But point number one is something that we should keep in mind. This stuff gets scary when we're in it. And I've got a bunch of people who have messaged me, family members and just friends, saying, "Hey, should I exit all of my positions right now? Should I exit my long-term stuff?" And one of the things to keep in mind is this too shall pass. Especially those of you who've been trading for a few years now. I've been trading for over 20 years, so I've seen just about everything that can happen. And somehow the market at some point keeps making all-time highs. We get through this stuff, and then we come out for the better. So however scary this seems, at some point this is going to end. And if we do hit a bear market, then we hit a bear market. But at some point that bear market will end. It never has not. So if we go by our odds of lifetime history, this is going to pass at some point. Just think of COVID. COVID was a lot scarier than tariffs. A lot of us thought the world might be ending, or Armageddon or something, right? And look at how quickly. Let's just go back to that 2020 chart. Just in terms of the market, within just a few months, we were back at all-time highs, right? And that's about the scariest thing any of us have ever experienced. And look at what the market did after that. We had a bear market that we went through that actually took longer, but took about we'll say about a year, maybe a little longer than a year, for this bear market to kind of play through. And then a year and a half later, we were back at all-time highs. So this stuff does pass, no matter how scary it is. We tend to really start to focus on where we are right now, today, tomorrow. But just remember that, and it kind of helps you that at some point this is going to be over. And the other way to look at it is, instead of being scared, if this does feel scary to you, think of it as, at some point this is going to give me an amazing opportunity, right? Maybe you're getting hit a little bit right now, but ride through it. And then at some point, if you just look at here, obviously there were huge opportunities in here, right, throughout this. after this bear market. Huge opportunities through that. So just try to keep, as you're kind of stressed out and managing what you're doing here, keep that in mind, and that'll make it a little easier for you to handle this kind of stuff. Okay, we got some names here from Joy, Tariff Con 2025, Tariff Gate, Tariff-Geddon, very similar to, okay, I've got Tariff-Geddon here. I like Tariff Gate. That one sounds pretty good. All right. Now, so I think most of you know what this whole tariff thing is. Some of you, because I've been getting questions about it, like what is this? How does this really work? So I'm just going to do a quick review of what this whole tariff thing is. So if you see it seems remedial to you, that's okay. It's going to lead to how we look at the market and how it's impacting the market. So that part is important for us. So at the most basic level, and we're just talking about this on the basic level, we don't care about economics, and we are not going to get into whether we think this is a good thing or a bad thing, or is this going to work, is this not going to work. At the end of the day, we can have those opinions. It does not matter at all. All that matters is how it impacts our trading. So that's what we're going to focus on. So what is a tariff? It's a tax on an imported good. And some people don't understand what's really going on here. When we say we are uh, putting a tariff on China, some people have this idea that China's paying this thing, and China is not. We are. So what's happening is there is a tax imposed on that imported good from China that's coming into here, and our U.S. importer is paying that. So it's hitting us. So we pay that. The U.S. importer is paying that, and of course, that importer is not going to eat that payment. They're going to pass it on. So it goes to the distributors, the sellers, and so on. And eventually, it ends up being a higher price for the consumer. And I know, obviously, there's some of you are going to come back at me right now and say, well, yeah, that's short term, but long term, we're going to have more U.S. goods, and that's a good thing, and we don't care right now. All we care about is what's happening short term and how that's impacting prices, the Fed, and stocks. So however we think this is going to work, it doesn't really matter in the future right now. It's just how does it impact us right now for our trading? Okay, so it ends up being a higher price for the consumer, which is essentially ends up being a kind of hidden tax on the consumer because everything is getting expensive, right? And the way Trump is trying to balance that is tax cuts, and looks like a tax cut passed today, and the Fed decreasing interest rates. So we have this tax essentially on us, a hidden tax that we don't really see, but we know it's there. And then obviously there was some stuff today. It looks like I didn't even know about it. I just woke up. But you try to combat that with tax cuts or the Fed decreasing interest rates. So that's basically what it is. Now, why is this important to us as traders? And remember that it's traders, not what we think about politics or nationalism or any of that. We don't care about that right now. How is this important to one? One, we know it leads to inflation, higher prices, and that's going to hit the consumer. And how does that impact companies? Consumers have less discretionary income to spend, right? If prices are higher, we saw that through COVID, and that hits the discretionary industries the hardest. So obviously, retail, right? Hits retail very hard. That's why when this tariff stuff hit, retail companies were some of the hardest hit because of that discretionary income. And then it hits tech very hard as well. So these are the two industries. I mean, it hits a lot of different areas, but if we think of the two areas that gets hit the hardest, and we need to know these things when we're doing our industry analysis and we're looking at what companies we want to trade, right? We want to know that these things are hitting, again, discretionary industries and tech the hardest. So that's something we need to know. Another thing we need to know is this impacts Fed policy. And we can think of a lot of things that impact trends in the market. The biggest thing that impacts our trends is Fed policy. And if we go back to the pandemic low, this big bull market, the bear market, the next bull market, all of this has been related to one thing, and that is not how good our companies are doing, how good tech, how good innovation is, anything like that, profits for our companies. It doesn't have to do with anything related to that. It's all been what the Fed is doing. Throughout post-pandemic, the Fed was not only cutting interest rates, but they were printing money. And you can see what happened here. The Fed started tightening up. We got the bear market. The Fed indicated they were going to start to loosen, and we bottomed. The Fed started to cut rates, and we got this big run here. The Fed starts to indicate that they might slow down because inflation's not moving the way they thought it would, and we start to get this kind of topping pattern. And now the tariffs have created more fear related to inflation, and we get this big move down. And mostly because it's the idea that the Fed is not going to cut rates anymore. And so this is all basically related to what the Fed has been doing. So that's really big. What happens to the consumer? What does the Fed do? And so, related to also, these trade wars that happen, because trade wars are not good for capitalism. What's going on with our companies? No, there's no free trade. Right now, reciprocal tariffs have started to hit, and that's basically what happened on Friday. Friday, China retaliated with more tariffs. And notice that the news came Wednesday after hours. Thursday is when we got the big move down. We look at what happened here. We got the gap down. But notice here, we already had the tariff news. We didn't do anything different. But when China came in and said we're retaliating, that's when we got the huge gap down here. And you can see huge move down here. And it was really twofold, not just because of China. There were two things that were in play. One, the China retaliation, and also so that happened in the morning, and we gapped down to here. And it felt like intraday that maybe we were going to recover. If you look at the intraday chart here, it started to actually look strong here, but then Powell started speaking. And there was this hope. We talked about it, the hidden tax, right? And there's two ways that we can be helped by that. One is tax cuts, which looks like happened today. And two is Fed policy. And Powell spoke later in the day and basically said he wasn't going to help, or the Fed's not going to help. In terms of specifically tariffs, they're going to focus on inflation. They're not going to cut rates because that's going to lead to more inflation. And whether you agree with that or not, their idea is if we cut rates more, inflation's going to really go through the roof, and we can't do that. That sounds like what Powell was saying. That obviously the market didn't like that, and then boom, we got that really hard hit after towards the end of the day. So that's basically where we are now. Kind of a recap of how these tariffs work, and essentially the why behind why this happened. Of course, at the end of the day, we care about the price action, what's happening here, but it's good to know, what's going on and the why behind it. That's a quick recap. Some of you maybe know this stuff more in depth, and you can really dig into the weeds on this. But as traders, this is essentially what we need to know, and we don't need to know too much more. Now that these, I'll look and see what this tax stuff is, but most importantly is how's the market going to react Monday now? And any good news, what we were talking about on Friday is when you're really beaten down like this, it just takes a little bit of good news for the market to get that reflex bounce. Now, we're not predicting that all this is over, but a tradable bounce could be in play on Monday. Okay, all right. So that's essentially where we are in terms of tariffs and what are they. And I think I covered this now, Thursday, Friday review, Trump, China, Powell. So we talked all about that. Now let's look at the market review. Let's actually look. This is all kind of, talking about what's happened in terms of, policy and economics and all that, and countries. But now let's actually talk about what we're most interested in. That is the charts. Now, we've been talking about this for a while. We've talked about this in Stocks and Coffee for like the last couple of months here. And obviously, we've been talking about a lot in the trade report, swing trade report, different way to use trade there, the swing trade report. And that is when this was developing here, pretend we don't even know what's happening here. When this was developing here, very similar to what we saw in the 2022 top, right? Ignore this, and let's just focus on what's developing here. Notice here, really big run off a low. And let's think about the reasoning. The reasoning was the Fed. The Fed was cutting rates and printing money. And we got this huge move. The Fed starts to indicate that might be over. And notice the trend started to slow down. And then we got this double top. And, Bear markets don't go in a straight line. Notice here, we got the violation of the 200-day moving average, a bounce, a run back down, a bounce, and then the next move down. Now, if we look at what's played out, almost identical, right? Big run here on rate cuts, indication of rate cuts, then rate cuts, then the Fed starts to get in their commentary a little more hawkish on rate cuts, and then they slow down the rate cuts, and then we start to top here, and we started to pull back here. Inflation numbers started to be more concerning, started to pull back more. Trump starts talking about tariffs. We start to pull back more, and then the big tariff news, and we get this big move down, almost identical. This chart pattern, I mean, and that's the thing about these patterns and why we trade them. History continually repeats itself, and we see the same things over and over and over again. That's why these patterns work. And now we're extended to the downside a little more than we were here before we got the reflex bounce. But for sure, I would say 99.5% chance at some point here we get a strong bounce. And we could end up being down here, but it likely is not going in a straight line. We are going to get a bounce at some point here. Maybe I got excited. I shouldn't have gone to 99.9. Let's make it 85%. 85% chance that there's going to be a bounce in here. Maybe this happens where there's like no bounce, but most likely we get a bounce in here at some point, and it looks like maybe it's Monday that it could happen. And let's skip down to game planning here now. So that's essentially our market review now. Now, what I've circled here is when the bear market happens and how it plays out, and we're looking very similar. We can also run this thing through and see a lot of spots where it looked like a double top was forming, but then we just get back on trend, right? Here, it looked like we were forming maybe another leg down. We violated the 200-day moving average, but then we just got right back on trend. So the question here now is in terms of we want to plan for a plan A, plan B. Again, no one knows exactly what's going to happen. This could be the extent of the move, and we get right back on trend, or we're gonna end up with a bigger downtrend or a bear market. No one really knows for sure. Before this tariff stuff happened on Wednesday after hours, I was actually slightly bullish. Our market breadth indicators were slightly bullish. Our watch lists were really improving. And then no one knew that the extent of the tariff news was going to be this expansive. And then obviously the market reacted like this. Now I would say maybe just in terms of the overall news, and this probably isn't going to resolve itself right away. So maybe we would say either neutral or even slightly bearish. And when I say slightly bearish, that doesn't mean there's not tradable bounces to be had, but just overall thinking where the market could go in the next few months, and also thinking about seasonality, that April, May, June, July tend to be weaker months in general. And then August on tends to be very strong, especially in the market cycle, election cycles we're in right now and everything else. That maybe we could even think of it as slightly bearish at this point. But we can think of that, okay, maybe we're slightly bearish, but at the end of the day, we watch what's happening with the charts, and we don't want to make predictions. We just base it off kind of what we're seeing. So plan A, plan B, when do we get aggressively long and when do we get aggressively short? So now we might think a bounce is going to happen next week, and we trade that bounce, but that doesn't mean we get aggressively long. We just trade that bounce, and we take some shots. We trade what we think are going to be potential bounces, and we don't want to risk too much. But the question is, when do we get aggressively long? Like, as we were through here when we were in this bullish run, right? And essentially, we want to have marked the key levels. And it's pretty clear here we can play potential bounces through here, but we play them cautiously, and we watch resistance levels very closely when the market is bouncing, and see how price action reacts to those bounces. So let's say on Monday, we get a reversal candle and we decide, okay, there's a potential for a rubber band bounce here. How do we trade this? We're going to trade it to the long side, but where do we take our profits? We're going to watch every single resistance level. This open gap here at 538 is a good spot to watch very closely. Then this range in here becomes an important level. And then, of course, the 200-day moving average, and at that point, the 50-day moving average will probably be converging at the same spot. that is the level where we get aggressively bullish. If the market makes a comeback, gets back over the 200-day moving average, it's essentially back on trend. And at that point, we get aggressive. The keyword is aggressively bullish. We can make bullish bets in here, but aggressively bullish would be when it's if it gets back up over the 200-day moving average. So that's kind of the plan A. Plan B, in terms of when do we get aggressively short, most of the shorts we've been doing now are hedging kind of shorts, and it's very difficult to get short here, right? You never want to short when it's already extended to the downside. So to get aggressively short here, what we would want to see is some consolidation and then a breakdown, or one of these rubber band bounces, and then a failure at resistance levels would get us short as well. So that's essentially the plan A, plan B. In terms of being aggressive, now in between we can take shots here and there, but we're talking like where do we ride trends? And riding trends is where you make the most of your money as a swing trader. So that's kind of the plan A and plan B. All right, I think I've got some questions through here before we move on. Okay. Okay, someone Richard said Tariff-Zilla. That's a good one. Howell says no one teaches about this stuff in elementary school. Yeah, it'd be nice if people understood economics a little better, or trading even. Alex Tariff Tantrum, that's a good one. Yeah, you're right, Richard. Simon's asking, are we using EMAs or SMAs? I use for my intermediate term and my long term. So intermediate term is 50, simple moving average. For the long term, 200 simple. For the short term, I use the exponential 9 EMA. So the only exponential I use is the 9 EMA. And honestly, I don't care what I use. The reason I use those is because that's what most traders are looking at. These moving averages are essentially, there's no real supply and demand behind them. They're self-fulfilling prophecies, right? Everyone's looking at them and trading a lot around them. And the longer term ones, even the institutions are, Goldman Sachs is the one who came up with the 200-day moving average back in the 1980s. So that's why we use them. If all of a sudden people started using exponential, I wouldn't hesitate to start using exponential. But essentially 50 simple, 200 simple, and then the exponential 9 EMA. And the exponential 9 EMA works very closely with the simple 5 EMA. If you, sorry, 5 simple, if you use just simples. Rahul's asking, how do we avoid trading a fake out? That's a good question. First of all, we have to be nimble. We have to be adaptable. One of the things I've been telling everybody, all our members through this period, is when you trade, keep risk small, because our edges are smaller in these spots. And because unpredictable stuff is happening. We can't predict, we couldn't predict the news that came out that has come out this morning, right? We didn't know there was going to be a tax cut this morning that's going to impact the market on Monday. We didn't know what the Fed was going to do on Friday. We don't know what Trump is going to say on Monday. So our edges become smaller in these kind of environments, but our edges become smaller, but our potential gains become big, really big, right? Our potential rewards, because think about this, if a bounce happens here, bounces can be very powerful. Even in bear markets, we can get very powerful bounces. So even though our edges are smaller, our potential rewards are bigger. So we still want to be able to trade them, but I always trade them smaller. So you can't get rid of the fake out. The one thing I always say is only enter trades on clearly strong signals. If you're questioning it, if you're saying to yourself, it's not really a reversal candle there, don't trade it. It has to kind of the setups have to scream at you. So that's one thing I do. And two is manage risk smaller. If you usually, your risk is usually 1%, so you're taking 100 shares, take maybe 60 shares to decrease your risk. Viraj is asking, based on past history, do you think it will be plan A or plan B? I don't know. That's the point of having plan A and plan B, is essentially we don't know. So I don't really have a prediction on that at this point. When more information comes and we can make that prediction, we'll lean towards more plan A or plan B. Laura's asking any thoughts on Tesla or Nvidia. They're the ugliest patterns of all the big techs right now. So I, unless they improve, I wouldn't be really looking to enter those. Let me pull up Tesla here. You can see here, Tesla. This is a classic short setup right now. You have the big move down, the reflex bounce, and then the failure at resistance level. You can see how it failed exactly at the 200-day moving average and starts coming down here. So as of now, it's either a short or you stay away from it. And I've been staying away from it. That would change if it gets up over the 200-day moving average. And these are not like set in stone predictions that we're making. And a lot of people tie themselves to, I'm saying this, so I'm going to stick with it. No, we adapt. And that's what we're seeing right now. If Tesla were to get up over the 200-day moving average, that would be a very strong move. And then we would look at it as a potential bullish setup. NVIDIA also a very ugly chart pattern right now. And there's really, and this all honestly looks very topish right now. And look at all this distribution that has been coming in right now. But again, that would change if you could get up over the 200-day moving average. Coinbase, very similar pattern here. There's really nothing to do with it. Now, with Coinbase is a little different in that it's so extended to the downside. You could potentially trade it as a rubber band setup if we get a strong reversal signal, unlike the other two. Tim has a good question. One of my hard and fast rules is never average down. So if you took an entry here in Coinbase at 274, your stop was here, but you say to yourself, you know what, I'm going to let it. It's gone so low that I think it's going to bounce, and I'm going to add more shares. You've doubled your risk on a stock that is really concerning at that point. And this is the spot where a lot of people will blow up or crush their accounts. So the only time I ever average down, and this goes more towards my long-term investments, not really my swing trading, is if I've already planned that I'm going to say take 1,000 shares of something and I start with 200 and then I'm filling it up. But if I've taken my position sizing, I will never average down. But that's a good thing to do with your long-term investments. Like say you like Apple, and you say to yourself, at some point, I'm going to have 1,000 shares of Apple. This is long term, and long term, you're not as beholden to stops and patterns and stuff. But let's say right here you liked Apple and you took 200 shares, and at some point you're going to go to 1,000. And then you say to yourself, nothing's changed within the company, and I like the stock even more now. Then I might add 200 here. And then if it goes down here, kind of like the Buffett way, right? And then if it goes down here, you could add 200 until you get to that 1,000. That's the only spot I ever average down. Otherwise, for your normal swing trading, me personally, I don't average down. And that comes from experience. And you realize every once in a while it ends up being a good thing and you make a lot of money, but the risk is just too high of really hurting yourself. Simon, for these moving averages, you do not include pre-market. Yeah, Nicholas is saying about capitulation volume. When we're extended to the downside, I always look for big upticks in volume. That's often an indication it's the last bit of selling. I don't know if this is capitulation because we have had spots where both to the upside and downside, we've had much more volume. But if this continues, I would watch Monday. If Monday we got even if it's green, if we got a big spike in volume on Monday, I think we could consider that capitulation. But it's definitely worth noting the volume uptick. Sea Turtle's asking, how do we know about inverse ETFs? I'll talk about that in a second. I'm going to go over a little something. A lot of good questions in here today. Okay, let's talk about. So we've talked about the market review now. Let's talk a little bit. I'm just going to hit these points. I posted this both in. I think I posted on X, and I also posted it in the Swing chat room a couple of days ago. That is just some general rules on how to handle volatile markets, especially, we're in a very volatile market right now. So I've got some general rules. I'm just going to run through these real quick, and you can take a snapshot of this if you want, or just go on X. I've posted it in the past few days. Um, just going to run through these real quick. The first thing is stay calm. Some people get very stressed, especially if you're sitting in some stocks that have gotten hit. There's this tendency to really start worrying and get stressed, right? You're going to make your worst decisions if you're stressed. Whatever's happened, you can't control it. Try to stay calm and just get in that good decision making mode. It kind of really relates to that "this too shall pass" kind of attitude. So remember that. Stay calm. Point number two, move your stops, look for support and gap levels. And what I mean by that is, let's say you were in this stock right here. Let's say this was a stock and you had got in right here, and then 3 days later, it's gapping down big. Your stop was maybe right here, but it gaps down to here. I rarely will ever get out, even if my stop has been blown through right away. And that sounds counterintuitive because one of our rules is, adhere to your stops. But this is the spot where sometimes it didn't happen here, obviously, it gapped down again. But sometimes that big gap down is the last bit of selling, and it's the worst spot to get out. So I usually will wait a little bit and see if the market stabilizes. And then at that point, if it does stabilize, obviously, you can get out at a better point or keep holding. By the end of the day, you have to get out because if you get another gap down, it'll crush you. And that obviously is what happened here. But watch your stops very closely during the morning of these periods and loosen them up a little bit, but that can be a slippery slope. So I'm not advocating, let your risk get way bigger. But let's say your normal risk is you allow yourself to lose $200. And now where it gapped down, you've lost 275. Is there a big difference between 275 or letting it slide a little bit and letting it go to 300, 310, 325? Not, not really, right? It's worth holding a little bit. Now you have to have that max pain where I say, okay, if it gets to 325, I'm out no matter what. So you do have to have that level, but watch your stops very closely. Point number three, someone was asking about inverse ETFs. Trade leveraged ETFs. I like to trade leveraged ETFs when the market gets very volatile. And for those of you who don't know, leveraged ETFs, and they have them for some stocks now too. It used to be just indexes, but now even like Tesla, Apple, and some other things have leveraged ETFs. But if you look at SPY here, notice here SPY was down on Friday, almost 6%, 5.85. SPXL is a leveraged ETF of SPY, 3 times leverage. And notice here, it was down 18%. So SPY was down about 6%. SPXL was down 18%. And that looks pretty bad, right? To the downside, you're even down more of a percentage, but to the well, so if the market was up 5%, you would be up 15%. So you get that extra volatility by trading these leveraged ETFs. So these work really well, like if you're trading a rubber band setup. And you really want to narrow your lists during these periods because if you've noticed already, while there are some stocks moving outside the market, we have a few relative strength stocks or some stocks that are moving a little differently. But for the most part, most stocks are moving with the market right now. The market becomes very correlated. Now, I like when the market is non-correlated, when a lot of stocks are moving outside of what the market is doing, outside of what different industries, they're moving on their own news. That's not what happens in these type of markets. The market becomes very correlated, and you're wasting your time parsing through thousands of stocks or making these 200 stock watch lists. You can narrow your watch list down to maybe 15 or 20 stocks and a few of these leveraged ETFs. So we know if the market bounces on Monday, that SPY will probably make a big move, and then SPXL will make it even a bigger move, right? If SPY were to be up 4%, 5% on Monday, SPXL is going to be up 15%, right? How many stocks are going to be up 15%? Probably not a lot. So the easiest thing to do during these periods where you're watching for the big market reversal is just trade these leveraged ETFs. So you can trade SPXL for SPY, TQQ for the NASDAQ. You can see here, same thing for the Russell small caps, TNA, and then a lot of notice this one's already was putting in a hammer on Friday. And then some of the industries, a lot of the industries have them. Like here's semiconductors, SMH. You can trade SOXL and so on. So leverage ETFs work very well. Someone was asking about the inverse ETFs. Now for these indexes, excuse me, for these indexes, we just looked at the leveraged ETFs. They're also inverse ETFs. So this is especially good if you're trading out of like retirement accounts or something and you're not allowed to short, or you just don't want to short. Maybe you're not on a margin account and you can't short. You can trade inverse ETFs. So if I'm looking at SPY and let's say I wanted to go bearish SPY, I essentially wanted to short SPY. I think SPY is going to go down to here. You can trade an inverse ETF. So for SPY, you could trade SPXS. And notice here, it's the exact opposite. So here, notice here, SPXL was down 18%. SPXS was up 18% on Friday. And you can see the big pop here. So you can do these leveraged, these inverse ETFs as well. So SPXS for SPY, SQQQQ for NASDAQ, TZA for the Russell. We were actually using this as a hedge. And we got out of it on Thursday. I didn't participate in this, but we did participate in this here. And then we took it off on this day here. But you can see here, again, it's up 13% because of the move on Friday. So you can do these inverse ETFs as well. Okay, all right. Point number 4, when these volatile markets start, before that market, you've been doing all this research, right? You've been looking at your setups, continuation patterns, breakouts, flags, all that stuff, right? Relative strength stocks showing good accumulation. Once these volatile markets happen, those setups don't work anymore. Throw all that hard analysis you did, just throw it out the window. All those good stocks, I got stopped out at PLTR. And this was a very strong setup. All of that goes out the window once the volatile market starts. So you want to throw what you've been doing out the window and adapt to what's happening now. We talked about inverse ETFs already. Look for relative strength stocks. During this period, you're not going to do a lot of trading as a swing trader. Most of what you're doing is watching and kind of stalking those moves that you're looking for. Like right now, we're looking for that reversal candle, right? So we're doing nothing right now and kind of stalking that move early next week. While you're sitting there doing nothing, one, you can be day trading because these are very good periods for a day trader. So while I've done very little swing trading over the last week, it's been one of my most active day trading weeks in a long time. But also build your relative strength list. Look for the stocks that are holding up really well during this period. Those will tend to do well coming out of this. What tends to do well coming out of these periods are two things, and they're kind of exact opposite. One is the stock showing relative strength. Two is the good companies that got hit really hard. So say like an Apple, or we talked about NVIDIA and Tesla, that get hit really hard. Those will have good snapbacks as well. So those are the two spots the two things you want to be looking for. And it sounds weird because they're exact opposites of each other, but relative strength and relative weakness, and this is the key in good stocks. Also, the other thing, when you're looking at relative strength, shy away from relative strength because of safety or defense. And what I mean by that is like Coke and Pepsi right now are showing relative strength. Packaged goods, because everyone has to eat, right? Grocery stores right now, because everyone, again, has to eat. Those are showing, they're kind of flights to safety, and they're showing relative strength. I don't care about those because when the market comes back, those aren't doing good. I mean, like, say, the momentum stocks that are holding up well. Netflix is one. Netflix is showing extreme relative strength right now. I know it's going down, but compared to the rest of big tech, it's holding up very well. Like, just look at the market is way below the 200-day moving average. Netflix is way above its 200-day moving average. So this is what I mean by relative strength, not the Cokes and the Pepsis and the flights to safety. Watch for stop gunning. You see this a lot in all markets, but especially volatile markets. The algos, the market makers, they know where we all have our stops. I always try to take a smaller position size, like on Monday or Tuesday, if I do a rubber band setup, take a little smaller position size, loosen my stop, because the algos, the market makers, they know what everyone's doing. And oftentimes you'll see this stop gunning and then the move happens. So one of two things. One, loosen your stops a little bit. Two, if you do get stop gunned, don't be afraid to identify that as a stop gun and get back in once you see the real move happening. There's this tendency, like say you were trading Apple on a rubber band setup. You get stopped out and you go, oh, this didn't work. And then you see it set up again, but you're scared because you got stopped out the first time. That second time is often the money move. So you want to be able to get back in. Point number 8, cash is a position. There's nothing wrong with just sitting and watching during a time when most people are losing. So if you're break even and everyone else is losing, you're essentially winning, right? By just breaking even. We talked about this already. Focus on all those key support levels. The market tends to trade very well around those levels. For the current sell-off, we already talked about the market and where those key levels were. Don't get caught up with intraday price action. It's really all about the open and the close. So watch those levels very close. Where does the market open? Where does the market close? Where are we related to key levels? And what candle patterns are we seeing develop? What setups are we seeing develop? Look for market breadth indicators. There's a number of them that we look at. Two key ones are, one is T2108. Look at the VIX as well. Equal weighted ETFs. You guys know I look at the equal weighted ETFs all the time. T2108 is on TC2000 is stocks above their 40-day moving averages. If you don't have TC2000, you can go to stockcharts.com. They have the same thing for stocks above their 50-day moving averages and for stocks above their 200-day moving averages. You can use it for two reasons. One, to look for overbought, oversold indications. And you can see right now, T2108 is very oversold. The last time it hit this level was way back in the pandemic low here. So we know the market's oversold. The other thing we can use it for is for positive divergences. If we start to see the market bottom and we already see T2108 stabilizing, we know we're seeing strong market breadth, that under the hood, stocks are starting to improve. So we can look at it for that. And during these types of markets, we look at this very closely. Compare RSP to SPY. SPY is not equally weighted. Apple and Tesla are worth 3%. Top 10 holdings right now are worth about 35% of SPY. RSP equally weights them. So you get a better indication of all 500 stocks rather than, being weighted towards those top 10 holdings, which is essentially big tech. And if you start to see improvement in RSP versus what we see in SPY, that's a good indication for us. So keep an eye on these market breadth indicators and watch VIX as well. When we start to see VIX subside, that's often a good indication. We see VIX popping here. If we start to see Monday, Tuesday, VIX start to come down, that'll be a good indication for us to potentially get long. You want to hedge during these periods where we don't have much of an edge. Mitigate your risk. Pair trading is a good way to do it. Go short, long. Sorry, excuse me. Go short one thing, go long the other. The idea being, if there's not much movement, you're going to win slightly or lose slightly on both. No harm, no foul. If you take some small wins or small losses. But if there's a big move in either direction, you'll win. You'll lose a little on your loser because you stop in. You'll win a lot on your winner, and then you come out ahead. So pair trading is a good way to hedge. There's better ways to do this if you know how to trade options. And there's straddles, strangles, a lot of good option strategies you can use. So whether it's with stocks or options, it's good to hedge during these periods. And then key in on reversal candles and confirmations. Reversal candles are obviously if you're seeing a market reversal or a short-term bounce or off a bounce, a failure at a resistance level, and then confirmations as well. Confirmations of a trend you might be seeing, whether it's a long or a bearish trend. So if you're following these rules, you generally will handle these volatile markets very well. Doesn't mean you'll be making a ton of money during these periods. That's not the goal. Your goal is really a defensive position where I want to get through this and not get hit hard. So when I get my edges back, I'm ready to go and I make a lot of money and I come out way ahead. So that's the key, being able to handle these volatile markets, not losing too much. And if you win slightly, that's great. If you win a lot, that's fantastic. It's like, having your cake and eating it too. But the biggest thing is being defensive, not losing too much during these periods. And that's the kind of mindset you want to have. All right. I think that's good for today. I was going to talk about the rubber band setup and deep out of the money calls. I think I'm going to save this for Monday. So the class starts on Tuesday. On Monday evening, I'm going to do a short webinar kind of previewing the class. And I'll talk about deep out the money calls and rubber band setups in there and a few other things that are going to be in the class. It's going to be a whole kind of swing class. And in the bonus session, I'm going to dig into options a little bit for you guys as well. So if you guys are, and I see some more questions, we'll get to those in a second. But again, if you guys are interested in the class, it's Bulls on Wall Street training.com/swing masterclass. And again, I'll put that in the chat here. And of course, you guys know about the swing service as well. And I am going, even if you're not taking the class, join me Monday evening. I think it's going to be 7 Eastern, 4 Pacific. And they'll be sending out a link if you're on the email list to that. And I'll go over some of this stuff in that class. All right, I see there's a few more questions. And if I skipped your question, it's hard to get through all these here. Just email me, singjd1@aol.com. Richard, Nail was one of the positions that I mentioned it at the time that I was turning into a long-term position, and I'm willing to hold it. And basically, I told everyone, if you're not willing to do that, that's fine. Just take your stop loss. Georgie, I've kind of alluded to what we're looking for right now, Monday and Tuesday. Essentially, we've got this big move down right now. And if it keeps cratering at this point, you just sit back and watch. But if we do get any strong reversal candles in here, that will be the spot where you can take some small shots at rubber band longs. And then from there, we reassess and look at, okay, if it does bounce, and we start hitting resistance levels, are they blowing through the resistance levels, or are they failing? And at that point, we could potentially take shorts. Richard, SPXS is 3 times leverage inverse of SPY. Rahul, good question. Because of the leverage, you're generally, if you're not holding it for years, the extra leverage overcomes the price decay. T. Murphy's asking what impactful news came out today. A tax cut, and I don't know much about it. Everyone was mentioning it here. I'll take a look afterwards. Richard, yeah, I think you should get an email notification to enter class. All right, guys, that looks like the extent of the question. If I missed your question, you can email it to me again, singjd1aol.com. If you're interested in the class, go to this link here, Bulls on Wall Street swingtraining.com swing masterclass. And if you guys have any questions that I didn't get to here, if you're a swing member, ask it in the chat. If you're not a swing member, go ahead and email me. All right, guys, talk soon. Have a great weekend, and I'll see you guys on Monday.